that the probability of these events happening again are much higher than what the industry shares with you. Because the industry and in the media as well, not podcasts, of course, but the mainstream medias, um, they always assume it's always a normal cycle in everything. A cycle is good or bad, right? It is what it is. But investors should understand that we do have potential for something breaking here.
Despite it seeming as if there's been a vast array of negative economic news over the past years, record levels of both public and private debt. There's more conflict than we've ever seen before, the highest interest rates and inflation that, for most of our lifetimes, markets keep going up. So I'm very happy to welcome Keith Dicker, who's the founder and chief investment officer at IceCap Asset Management, onto the podcast today. So Keith, thanks for joining the podcast today.
Oh, hey, Anthony. Thanks for having me on. And I love the introduction, record debt, record inflation. It sort of hits with the theme today in that, from our view, and we've had a lot of success with our portfolios over the years, and that if you could identify where risk are in the markets, then those markets are plural, of course, and it's much more than just equities and fixed income. I think it's just sensational. Because if you can identify those hotspots and where to avoid them, or if you play the short game, you can go there as well. But if you're an investment manager and you're not excited about things today, then you just shouldn't be an investment manager. Like these are really fun times to be alive in this world. Anyway.
Yeah, it's interesting. So I guess where do you see the risk in the markets at the moment?
Yeah, I think the first thing to start with, just a little bit about our background. Then, because perspective is everything, of course. So like we're a Canadian-based firm. So I started off working with one of the big Canadian banks for a number of years, doing like all the fun stuff. And but then I lived offshore as an expat for 10 years, actually 11 in a bit. And that's where I was running a multi-currency, multi-strategy desk, for wealthy families around the world. And what was so incredibly interesting about it is that, all these wealthy families, none of them became wealthy from the market. They all became wealthy from selling a business or inheriting the money from selling a business. That's the way it works. And their sole objective with their investment portfolios was to maintain value, don't lose money. So, for example, if just say markets are down 30%, if I walked in and I said, hey, you're only down 20%, I had a 10% alpha, because, we're pretty awesome, they'd fire you. They say, hey, that's not what we asked for. And the same thing on the other side. If markets are up 30, I walk in and I say, hey, we're up 25, and they'd also fire you. They say, hey, you're taking on way too much risk. And so I share this story because the industries, with the industry today, whether it's in Canada, over in Britain, Australia, America, you name it, somewhere over the last 20, 25 years, and I blame the CFA Institute for this, and I've gone through all the CFA exams before the internet was created, basically, but that they've managed to that the industry treats everyone as if you are an institutional investor or a relative return investor. So again, if markets are down 30 and you're down 20, you should be happy with that. Whereas, from our experience, as if you're an individual, we're much more sensitive to losses than we are to gains. And I mean, just the way the maths work with it, if you lose 50% in anything, 50, half 100, you need 100% return to get back to where you started. So I just share this perspective with you because, when you're offshore for so long, the other thing is you also appreciate that most people, they view the world through their own lens. So if you're in Britain, you're viewing the world, as if you're British, you're using your morals and your ethics and your values. You think that's the way the rest of the world should operate. Canadians do the same thing, Americans do the same thing, and you name it. But that's not how the world works. It's a very big place. It's a fun place. People are very interesting. But as soon as you appreciate that, then you can start to figure out, okay, yeah, there are different ways to make money. There are definitely ways to avoid losing money. And then if we take that and you overlay it on top of the global macro landscape that we have today, but that's what I mean by, hey, these are really interesting times, and everything we've learned in the past, whether it's in university and textbooks, it's probably not applicable, for the next 30 years we have coming up. So, you can just sense the enthusiasm that we have, because if you figure this out, then, it is a fun time to be alive with your portfolios. It really is.
Yeah, it's really interesting. So I guess from your perspective, what do you think is happening in that macro environment at the moment?
So the biggest thing that's happening right now is that we're living in this significant shift in that, from the early 80s to really 08, 09, long-term rates went from 20% to zero. That's effectively what happened. So, we've had 30 years of just rates going down like that. And when rates are going down, long-term rates, everybody makes money. Like it's pretty hard not to make money. Now, of course, we get hiccups along the way and things like that, but it's incredibly profitable time to be invested, especially if you're in the bond world. And then once that hit 0% in 08, 09, because of the great financial crisis, what central banks did, they lowered rates to zero. Some places went negative. They started using quantitative easing, and they bailed out, companies and individuals indirectly and stuff like that, because they couldn't allow the system to reset the way it should have reset. And the reset would have seen, debt getting written off. A lot of companies would have went under and stuff like that. But there's so much private capital around the world. It's just gushing in savings around the world that it would have replaced those losses, and then we would have reset and went on to our new environment, whatever that was going to look like. But instead, central banks, they proceeded for over a dozen years, from 809 right up to the pandemic, to really keep overnight rates at zero. They try to suppress the global yield curve. They just prevented price discovery from happening. And as this continued to happen 1 year after the next, I was in this 5 years, 10 years, you had, 2 generations of university kids going through school, learning about, the capital asset pricing model and, other the efficient market hypothesis and all those things. Did you learn about those when you were in school?
Yep, not too long
Yeah,
ago.
you can rhyme off the formula for the CAPM model and all that. It's funny, it doesn't work if your RF is zero, right? It just doesn't work that way. You put a negative sign in, it just blows everything up. But my point is, though, is that you obviously you had entire generations of students, universities. Obviously, you had people working in the industry for 10 plus years, all during a period with QE, zero rates and negative rates, excessive borrowing. And we sort of been lulled to sleep into believing, yeah, this is a normal functioning economy. This is the way things work. And it's been going on now for 30, 40, 50 years. And because that's a long time, that's enough time to do any historical studies and predict what's going to happen going forward. And it's our view that that's completely wrong. So everything that's happened, from basically the early 80s to today, there's 40 years, you're going to probably get, it won't be as dramatic as this or the mirrored relationship, but it can be almost the opposite experience coming up. And once you sense that, and then you put on top of that, everyone has been either encouraged or enabled to borrow excessively more over the last 10 plus years. So that's households, corporations, and especially governments. Corporations are the healthiest, by the way, but a lot of households, especially here in Canada, boy, if we get a recession up here, it's going to be pretty traumatic for our economy. And then governments as well. They've all been living in this false sense of security that they can continue to borrow forever, always roll over debt, and nothing can hurt you. But now we're at this point, and I like to use the phrase or the expression that we have synchronized risk around the world. So as investors, you'll know that there's always a risk in markets, and of course you also always acknowledge that there's always a hot spot somewhere. So whether it's somewhere in the emerging market world or a specific industry like energy, for example, or something like that, there's this stress out there. But right now, if you look at the policy response from the pandemic, where they've effectively shut down the global supply chains, and they paid everyone to ensure that demand at least maintained this level, but actually went up. So in your old, your supply demand curves that you guys would learn in school, like it's been completely distorted because the supply has actually decreased, demand's gone up. So we're trying to get through that right now, and this is what I mean by risk has been synchronized. So the Canadians are in the exact same position as the British are, as Europe is in, as the Americans, Australians, and Japanese, and so forth. And like for Canadian clients that we have based over here, we share with them, they'll say, should we be concerned about Canadian banks and the Canadian housing market and stuff like that? We say, of course you should. You should always be worried about something. But what we share is that the risk to Canada, what could cause markets come off aggressively, it could be an event that is triggered from outside of Canada. So it could be Australia, for example, or it could be the Japanese or Chinese or something. And that's the way, if you view the world today, it doesn't reduce the risk, but it just gives you the opportunity to see things better and to better appreciate how you can protect yourself.
Yeah, it's really interesting. I'm not sure what the term is. I'm not sure if it's polycrisis or there's this crisis where it's actually the sum of all. Say if that were to happen somewhere else and there was almost a domino effect, it would actually be worse than the sum of all those crises because of the how intertwined it is. I'm not sure if you've heard that before.
Yeah, I haven't heard that phrase, but it certainly is. So what else are you hearing? Are you hearing a similar kind of story? For example, are Australian or British investors, are they concerned about Canada as an event? Are they concerned about, I guess we're always worried about the Americans, right? Because you never know what the Americans are going to do. But do they share similar views?
Yeah, it's hard to know as well. I feel like people are almost desensitized because, there's so many times where we think, oh, this is the top, this is as much debt as we can have. There's going to be a turn. But then I guess they keep printing and they keep, they keep continuing with it and they keep finding a way to prop it up. So it's almost desensitized against that, which is even more concerning, where there's not an understanding of the, as you said, that risk that is, occurring across the world.
Yeah, because I mean, if you think about it, pension funds are never worried because their institutional money is structured to be multi-generational. Everyone attached to it, they have no skin in the game, right? It's consultants run the pension industry basically, not investment managers, and it's done on a very long time frame. And it's not good or bad, it is what it is. But just think about that: the majority of households that have a nice pot of savings built up now for their retirement, they've accumulated most of that pot over the last 10 years. So during this very environment, that I shared, that what rates, money was free basically, and now they're the ones who are deeply exposed to any of these fissures that take place. So we've come across or bumped into a lot of investors. They're basically set to retire at the end of 21 because 21 was a great year. People made a lot of money. They're rubbing their hands together. They're ready to retire. Go hang out in Spain or something. And all of a sudden, 2022 happens, and they've lost 10% of their wealth, 20% of their wealth. Now they can't retire. They can't do all these cool things. So it's our view that the probability of these events happening again are much higher than what the industry shares with you. Because the industry and in the media as well, not podcasts, of course, but the mainstream medias, they always assume it's always a normal cycle in everything. A cycle is good or bad, right? It is what it is. But investors should understand that we do have potential for something breaking here. And when we look at this, you always have to appreciate that capital, it literally has to go somewhere. Like it just can't go off grid. It has to gush somewhere. So think about the world, the core, it is America, the US dollar, the treasury market. And then you can start moving out in these centric circles all the way out, and put like G7 countries next, and then the bigger ones around that, emerging market world, and then the frontier countries out on the back. In good times, capital leaves the US and goes out. So you get a weak dollar and, strengthening emerging market world and those things. And then the opposite happens again. So the way that investors can protect themselves today is that if we do get one of these fat tail events occurring, it doesn't mean it has to, but the probability is there. It's highly likely that the dollar gets a very strong bid. So you can see Canadian dollar, Aussie, the pound, you name it, like that could come down, pretty aggressively versus the dollar. And it's not because America is better or worse. It's simply because it's the only place to park money. You can't park it anywhere else. So I just think that there were some great ways to protect yourselves out there on the currency side. It absolutely offers that. And then you're getting all these other neat plays right now being set up in the commodity world and so forth, simply because the supply demand dynamics have changed because of the COVID policy responses.
Yeah, it's interesting. So that US dollar theory, is that the milkshake theory? I'm not sure if you've heard that. Have you heard the dollar milkshake theory?
Yeah, actually, Brent and I are quite good friends.
Okay.
So I always, nobody ever asked him. Yeah, the IceCap guy. Nobody ever asked Brent that. But I'll chat with him after this call, and he'll laugh. I'll go, yeah, I kind of know Brent. Yeah, it absolutely is. It is a function where. And by the way, that's a very, very effective and strong analogy that Brent created to describe that. In that, for people who may not know, it's basically using the analogy that the US dollar system can just suck up foreign capital from everywhere. You may not even realize it's happening, but it is happening. And then the opposite can take place as well. So, there's a lot of stresses being created today, especially in the geopolitical world that is happening. And, all these events that they're all intertwined and linked together. And you can have one event that will, the whole butterfly flapping the wing, theory, all that stuff. Like it literally is true, but it doesn't mean that you have to, run for cover and, put your money on deposit or anything. Like there are ways to manage your savings and your wealth and continue to earn positive returns and all that. It's just that the more you are aware of this, the more you become engaged with the global macro world, because it's a global macro world and we're living in it, and that's what it is. Then you shouldn't have any big surprises when events are taking place, because as an investor, there's nothing worse than you get surprised by something and you've lost, you got cut off at the knees with your savings, and that's not fun at all. And so we're just sharing that. Yeah, I think the visibility is quite clear on where we're likely going to go, and because of that, you might as well make some money on it.
Yeah, definitely. So do you see, you mentioned Canada might be in a bit of a sticky situation. I guess you could link to lots of other countries that have high private debt. So the UK, Australia, even, China, these places where real estate has been a massive bubble over the last 20 years. Do you see those places as maybe the potential for a catalyst? And then I guess another question, once the US dollar does increase in price, do you think then US assets are also going to increase? Is it going to be that these investors are going to have to find somewhere to park those dollars in an asset?
You can have sort of one market move leading the other, but then they all start moving at the same time. But using, for example, if we had a housing bank crisis in Canada, if the rest of the world wasn't in sync with Canada, then it would just be a Canadian story. Like nobody else, should be worried about it. Or if it happened in, Australia or, wherever else. But like using Canada as an example, people may or may not know this, but the housing market in Canada basically went vertical over the pandemic. And as a result of the high inflation data that was coming in, our central bank here raised rates from basically 0% up to 4.25%, and they did it very quickly. And that had the effect, of course, of it had a very strong negative effect on people with variable rate mortgages or floating rate mortgages, whatever you want to call it. So all of a sudden, people had to pay more on their monthly mortgage. I mean, you had less money left over for discretionary spending or to go to hockey games and stuff. And you got to go to hockey games, Anthony. You don't do that in Canada. You know, it's a bad thing. But you had all that happening, and now we're at this point where, okay, we've sort of settled in. It doesn't seem like there are going to be any more rate increases, but we haven't had a recession yet. If we do not have a recession, then we'll work our way out of this. And if there's no other external events taking place, we'll be okay. But if Canada experiences a recession that is a little bit harder than soft, then you have aggregate job losses. Then banks are writing off. They're writing losses on their mortgage portfolios, maybe other kind of loan portfolios. If they already packaged them up and sold them off, and some other schmuck has it, they have to take the losses. You can't get rid of an asset, right? It's out there somewhere. And then you can, maybe another investor gets nervous, in Australia, or you never know who is overexposed to one specific market. But that's the kind of event that, again, you have to be aware of. Is if it happens, like, oh yeah, we should have known that was going to happen. But I don't think people need to be, incredibly worried about equities, for example, because people always start off with, if you're worried about something, the stock market is going to crash. It can certainly have a wild ride coming down here. I mean, it could be an extra 20% that just continues the channel we had that started last year, or at the end of 21 and early 22. But the belief that we're going to get like this, 50% market crash and everything, that's unlikely to happen, simply because it's not the corporate world that's in bad shape right now. It's the public sector. It's the government world. So they're the ones with the horrible balance sheet. If we go in a recession, government income statement is getting hurt, their top line. If they try to raise prices on the government side, which is raising taxes, then that's going to reduce aggregate tax revenue coming in. So again, it is the bond market that, for the first time in our lifetimes, it is the one that's it should be flashing red for investors, especially the emerging market world and the corporate debt market and stuff like that. Because that's the one that can really, push people, off gear. But if that happens, though, it leaves currency markets are open, equities are open, volatility markets, commodity markets. Like, there's a lot of things that you can look at. It doesn't have to be that two-horse race all the time. What else are you seeing on your side?
Yeah, I find that really interesting because I guess this might be, my investing career has probably been past 5-10 years, and there's always you're almost ingrained and buy the dip. And that's the thing, it's almost like this fear of missing out, where in our whole lifetime, we haven't experienced the recession in 2008. Since that period, there's been these sharp drawdowns like we saw in COVID, and then you could potentially say even the last few months of 2022, sharp drawdown, but then there's always that up. And it's hard to almost see a big crash that lasts for longer, like we saw, you could say, after 2000s and 2001 with NASDAQ crash, or after 2008. It's hard to see that systematic crash or systemic crash. But,
yeah, one of my friends, Mike Green, you might know Mike. He's on Twitter. He knows this subject really well. But it's all of it is like it's a conversation about passive money flows coming in. And so on an aggregate basis, again, there's so much savings coming into the system. So, Mike will share with everyone that, if you're on a 2-week pay cycle, for example, or a monthly pay cycle, you're socking away 2, 3, 4% into a retirement type product, and the company is matching it up to this 8%. And they're buying equities no matter what. They're just trained to buy that because that's the way that the system is put in place. And so that's another way to appreciate our global system. There are a lot of natural shock absorbers out there. And which sort of comes back to the other point I didn't quite finish with, Anthony. If I'm talking about how the government bond market is really the market that everyone is sort of looking at through the side of their eyes. And central banks know this. Those central banks are going to protect their sovereign debt market at all costs. They have to. Because if their bond market goes, then the government is gone, pension funds fail, banks fail, you name it. So they'll always protect their bond market. And because they'll always protect their bond market, it means that the currency side is left wide open. That's where the risk will be expressed. So when I was showing earlier and talking about the US dollar being the core of the world and all that stuff, that's because it can get bid in this time of a big crisis taking place. Look at Japan, for example. They have some changes taking place at the BOJ. And everyone's kind of trying, kind of waiting to see, which direction they're going to go. But if it's our suspicion that they will protect the bond market. They might let the 10-year go up a little bit, but they can't let it go any higher than that. So therefore, the yen has to be the market where risk will be expressed. And so that's why currency markets can be a great addition into anyone's portfolio if you're able to structure it that way.
Yeah, and I think governments have a lot more they can do to protect the bond market. You could say that they can force pension funds to own a certain percentage of their assets in government bonds. You could also say that rather than them, keep continuing to print money, they could just do government-backed loans through banks specifically, almost like a Chinese system where these large banks will then loan out, and it's actually not on the government's balance sheet. So I feel like there's sort of other methods that they could do to consider, and I think that's something that Russell Napier has said. There's things that the governments can continue to do to prop this up, and that's where the currency play would be more likely to occur.
Yeah, you don't need to go to Hollywood to see a creativity in a movie. You just have to see what the central banks and places like that are doing. And then, of course, we're all familiar by now, of course, with the central bank digital currencies that they are going to come, right? So don't be shocked when they do come. It's our view that they only come after the crisis has occurred. I find it unlikely that they'll be able to do a soft introduction and work its way through. But all the central banks are working on this and at this. How it looks, who knows? But because they are looking at this, and it's not because people are using electronic money more for everything. I do. I rarely have cash anymore. Whenever I have cash, my kids want it. They need it to go do stuff, right? But it's different than a paperless cash society. It's all about really protecting commercial banks and then the reserve that they have to put aside. But if that's something you can focus on another conversation on the road.
Yeah, it's fascinating to think. So I guess in terms of a time frame, what are you thinking? Do you have a sort of thoughts on that? I know it's a fool's game to predict when these things will happen.
Well, I suspect we will have a significant crisis of some sort, anytime between the next, 6 to 36 months, whatever it's going to be. Maybe it's this month or maybe it's a couple of years out. But again, it's our view that the probability of the world achieving this soft landing coming up, it seems like nobody wants a peace deal between Ukraine and Russia. I never hear of that taking place. It's always about arming up. So there's a lot of things that are happening again that increases the probability that we will get this financial accident taking place. And I think that once it does take place, if you're positioned properly, you'll make money on it, or worse, you'll be able to preserve your capital. Maybe just have a couple of points of a drawdown. But then you're ready to buy a lot of cheap things on the upside.
Yeah, which is really interesting. So Keith, thanks again for your time today. I really appreciate it. So I guess my last question is, what is one message you want people to take away from our conversation?
Yeah, I do want to connect with us. I am on Twitter, so it's at IceCap Global. You can find me there, as well as our website is IceCap Asset Management.com. It's the long version, all spelled out. and you can just fire me an email. I appreciate being here, Anthony. This was a real nice conversation.
Yeah, thanks for coming on. I appreciate it. I'll put that all in the description below. But yeah, thanks again for your time.
Perfect.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.